Hello, everyone. This is Richard Amoy, co-founder of Investor Next Door Club. Thanks for hopping on for tonight's masterclass talking about assisted living. And I'm super excited and honored because we've got a good friend and mentor of mine. John and I have known each other now for about a year. We've been working together in a coaching participant relationship because John manages a fund for a large multifamily group and now assisted living. And it's just been really exciting to be able to have that iron sharpening iron relationship. But I'll say you this, from John having incredible skills and incredible character, he's also a great family man. So it's like for me, it's important that it all comes together because sometimes people got the skills, but they don't have the character or they don't have the family dynamic. And for me, the people that I try to keep close to me, they're all going to be someone that I aspire to be in some aspect of what they're doing in their life. So we're super excited to be talking about assisted living. I'm not going to steal any of John's thunders. He's had an incredible track record in with car washes, multifamily, and now with assisted living. And I just want you guys to really get an understanding of what this whole assisted living trend is, and it's going to be here for a while. And John's going to talk a little bit about that. So I'm going to turn it over to you, John. I appreciate you being on tonight. This is going to be fun.
Richard, thank you for having me. Like I said, it's been nice knowing you the last year. We've developed a good working relationship, and we've had a lot of great conversations about real estate investing. As Richard mentioned, I've been in multiple asset classes: car washes, gas stations, oil changes, office, industrial, single family homes, and recently multifamily, and what I consider really a branch of multifamily, which is now senior housing. So, Rich, is it okay if I share my screen? And
Yeah, absolutely.
okay, great. Um, so we put together this little presentation to kind of show you, number one, why we've made I wouldn't really say it's a switch, but we've ventured off into senior housing. I think multifamily belongs in every real estate portfolio. It's got a lot of benefits, but senior housing has some. Well, as we get into, you're going to see the demographic shift in America. And for a lot of different reasons, we see this for probably the next 25 or 30 years as a really strong asset class that we recommend we put in everybody's portfolio. So I'm John Letters. I'm CEO of Cree Capital. I've been the CEO of Cree Capital for several years now. My partner, Rod Cleef, is host of one of the largest commercial real estate podcasts in the world. That's how I got to know Richard. And so we're going to talk a little bit about senior housing today. So what we're going to cover tonight is number one, the demographic population increase in the senior demographic. Everybody hears a silver tsunami is coming, but they don't understand what that really looks like and how that affects the supply and demand equation of senior housing. We're going to talk about increased affordability due to maturing net worths. This is something that has really hampered the multifamily right now because the rent increases we've seen between 2019 and 2023, they put a lot of downward pressure on rents. And as we all know, the inflation that the Fed's been trying to fight for, well, they've been trying to fight it for 4 years, but it's been ongoing for, we all know, realistically longer than that. It's hurt the expense side of traditional multifamily. There's a major shortage of supply, which we'll go over really quickly, and the increasing cost of construction on all these new builds. Right now, we just got a project we're looking at on new construction, and it's going to cost about $350,000 per bed to construct these asset classes. The demand that we're talking about coming with Alzheimer's. Unfortunately, we all know that Alzheimer's is an um, increasing Alzheimer's risk factor, and how we care for those patients, especially in some areas where we have a declining younger population, is going to be a real issue on how we handle that as a country. And also, we'll talk about how you guys can get involved. So this here is kind of, I think, it sums up the supply and demand side of the equation of senior housing. If we look here, this lower green line is what we're producing every year in new units of senior housing. Part of that is due to the cost, $350,000 per bed, and also the time to stabilize the cost of the capital for the project. This upper green line here is the most units we've ever produced as a nation in 1 year. I believe that was 1999. And this 63,000 box right here is what is needed right now to maintain 90% occupancy. So as you can tell, there's a substantial shortfall between 63,000 and the current production. This year, this was last year's numbers. We're only at 20,000 this year. So this curve becomes a little bit steeper as we move on closer to 2030. This brown box is the sum total of the shortage, the aggregate shortage of senior housing units in development today. I don't want to bore you with all the details, but basically, as you can see, this trend continues unless something shifts to drastically increase production over the 1999 levels. We're going to be at least a $609,000 or 609,000 unit shortage by 2030. This orange line here really represents the demand. This is the increase in the 80 plus population. In senior housing, there's a lot of different demographics that we look at. Primarily, we focus on assisted living and memory care, and that is predominantly the 80 to 85 population. That's scheduled to increase 3% in 2025, 3.1%. Next year, there's a 7.3% increase. And as we see in future graphs, this continues out till about year 2040. Elder population growth. This is the population growth, not the actual population. It's not declining population. These are these spikes in populations in the 82 to 86 demographic, but we're really looking at the aggregate total between the 80 plus and the 82 is our target market for assisted living and memory care. As we see, these are sharp increases for any demographic. When you look at a 12, 13% increase in 2028, there has to be some type of adjustment made in the supply of senior housing to fix this. This is something that we talk about. This is the dependency ratio. The dependency ratio is basically how many people we have aged 19 to 64 versus every person that's in the aged population. As you can see here, right now it's about 12 to, well, in 2022, it was about 12 to 1. And now when we get out here to 2050, it's going to be about 22 to 1. So we're going to almost double the amount of seniors per working age population over the next 30 years. What that means is more, I'm not trying to say this in a morbid way, but more dependency on the system and less people supporting the system. And Richard, feel free to jump in if you have any questions on this or you need me to slow anything down. This here is another graph regarding the overall need. It's very similar to the other slide, but this goes on a year by year basis and extends it out past 2030. Here we're talking all the way out to 2045. So there really is a long horizon on the demand side for the senior housing. Like I said here, this is the current development at 26,000 units. It's actually lower than that right now. This is the most we've ever done at 56,000 units. And it isn't just a short-term supply problem. You know, some people look at the first graph and they say, yeah, well, there's the baby boomers are just turning 80 right now. So how long is this supply and demand equation going to be out of equilibrium? And when you look at this here, if you look at the sum total, unless we have some major development to start absorbing all of these, all the demand, they're saying that this could not get fixed for another 20, 25 years. I saw they're saying within the next 7 years, they need $270 billion of investment within the next 5 years. So
It's incredible.
yes, it's incredible. It's a little bit scary, right? If you are obviously my partner Rod and I, we had a roundtable discussion today, and we're talking about, what does this look like? And he brought up a lottery system to get into senior housing. I don't think that's the case. I think that might be the case for public pay. We don't really focus on public pay. Public pay is the Medicare, Medicaid subsidized. We only do, but I think there will be some drastic increases in quality units.
What's the youngest age you see going into assisted living? So I know you're talking about 80, 80 years old being kind of like a big number, right? I mean, do we see 75, 72, 70? I mean, obviously
Yeah.
memory care can start, unfortunately, at almost any age these days.
Yeah, that's a great question. We just have a six pack under contract in Texas. So I was touring assets all last week, and you see different assets, different markets have a much different age constraint. We saw one and they were much younger. They're probably 75, 77 in that age, much more active. A lot of activity based, amenity based, hair salon, nice movie theater, a lot of activities, pickleball courts, so there's really there's a blend. And this is very specific to different markets, right? Licensing is not uniform across the country. So when we talk about senior housing, we have independent living, we have the 55 plus active adult, what they call it, to independent living, which you're basically taking care of yourself, big common area, a lot of amenities. It's more of a want-based product, right? Then we get into more of the assisted living, where there's assisted living A, which is self-evacuation, which means they have to be mobile, they have to be able to care for themselves a little bit more, but they might need help with their medication. They might need help with um, laundry, cooking, cleaning, stuff like that. And then as we move through, then we go assisted living B, which is, more wheelchairs, walkers, unable to evacuate the building. And in each one of these levels, the cost increases. Then we get into memory care or dementia memory care. And then there's also skilled nursing, which is something we don't get involved with. It's more hospital based. So when we look across these here, this is independent living. You see the demographics of why we love this asset class, why I think it belongs in a portfolio. We'll talk a little bit more about the return structure and how it fits in with what we're all really looking at this for, which is maintaining our standard of living or improving our standard of living through real estate-based assets. So if we look in here, this is basically operating margin through assisted living. We talk about independent living up here, which it's a smaller price point, but usually more consistent margins, less care based, right? Less dependency on labor. So you basically more dependency on labor, more marginal cost. All of those things kind of play into this. But the lower quartile, the 25%, have about a 15% operating margin. Upper quartile are operating at a 43% margin. Freestanding assisted living, lower quartile are losing money, right? That's usually occupancy based. The upper quartile, fully occupied, um, stuff in the $6,000 or $7,000 per month price point. They have larger operating margins. At Cree Capital, what we're really focused on is buying assets in this lower quartile. Right? We're buying distressed assets. They're either losing money or they're underperforming. And through fixing occupancy, automation, sometimes cost savings, marketing, facility maintenance. Sometimes some of these operators, mom and pop operator, built these things 30 years ago. They're 70 years old. They don't have the means to come in and renovate an asset, to put, sometimes $1 million, $2 million into improving these to increase the occupancy. So basically, if you look at our business model, we want to buy assets that are operating here, and we plan on moving closer to the median. These upper quartile, those are really outliers. They're unicorns. They are out there, but they're a little bit harder to come by and definitely harder to plan for. Freestanding skilled nursing, like I said, this is not something we get into. It's heavily care based. Um, Pricing models are much similar to a hospital. Planned community, same thing. This is totally different asset class that we don't operate with at Cree Capital. This is the other part about this asset class. We look for assets that are able to be converted to Alzheimer's. If you look at this population increase of Alzheimer's, we talk between 2020 and 2040, the percentage of the population or the number of people in the population that have Alzheimer's is going to double, right? Those are people that don't have an option. These are not people very hard. It takes a very special person to be able to stay home and care for a loved one with Alzheimer's. So we're helping to solve that equation. We're taking underperforming assets. We don't want to spend $350,000 a door. Our business model is find assets that we can buy for the $30,000 to $70,000 a door, renovate them. I am not I care for the elderly, but I am not the person you want caring for your elderly. I don't have a great bedside manner. I'm good with numbers. I'm good with roofs, HVACs, renovations, and I think I do a very good job of interacting and associating with people who are very good on the care side. So I handle the facilities. They work on the operation side, and provide the care for them.
It does take a special operator to keep that because that's a community, right? I mean, they got to really provide value for those people to, take care of them. And unfortunately, there's a lot of facilities that they don't, right? They just look at the dollars and they don't really look at the human, which is, a travesty. So it's like the demand's there, but also the demand for real care is even more so and finite.
Yeah, and especially when you walk into these units, you can feel it, right? This is something you feel when you walk in the door of the operators that really truly this is their calling. There can be a lot of money in this business, if it's done right because there's big margins. As we get into it's very affordable compared to other asset classes. And you can see the ones that really care about the elderly and spend the time with them. And it does actually translate to the bottom line, but I don't believe it's something you can fake.
Right.
So when we talk about affordability, this was always a question. My grandfather spent time his when he my mother took care of him until he was, I think, 82. And then he got dementia and eventually Alzheimer's, and she couldn't take care of it home anymore.
Mhm.
And it was expensive. I remember it was very expensive to have him cared for. We didn't have insurance for that, but it was definitely a burden. And what you see now across here, the based on the run up when this was 25 years ago when they didn't have this big run up in housing value. So what we're seeing is right now the affordability for seniors between what they have in Social Security, what they have in pensions, and in home values. This is the most affordable time, and so there is um, the senior demographic. If we're able to keep this in the 3,800 to like $4,700 per month, all in, the average person stays in a assisted living for about 2 years. So if their burn rate on capital is maybe 12 to $1,300 a month, and if they have a $200,000 value in their home, they can live out their life in comfort, good food, activities, for those 2 to 2.5 years that they need the assisted living care. Quick snapshot of what our business plan is and what we're working at right now. This is a Texas rodeo portfolio. No one's seen this yet. We're actually having our webinar next week. So yeah, no one's supposed to see this yet. So you guys got the sneak peek. But basically, it's 6 assets, two in San Antonio, three in Dallas Fort Worth area, one in Houston. It's got we're planning for 393 units. Now it's licensed for 600 beds. We play around with the unit mix. When you have single occupancy rooms, double occupancy rooms, they all have a little bit of a different. Well, double occupancy is really good for memory care, right? They like having somebody else in the room. They communicate. They don't feel so lonely. If you have Medicaid, double occupancy is fine. Most of the time, when you look at a $4,500 price point, someone who needs help with their medical, they might need help dressing. They don't necessarily want to share a room with somebody else. So you have to really balance that. We end up with it on this asset here at 393 beds. The current occupancy of this portfolio is an average occupancy of 63%. So on this one here, our business model is really buying this here, 63% occupied. We actually, on some of these assets, we're going to reduce the rent short term to increase this occupancy up to 85%. Now, market occupancy across the country is 90%. We're targeting 85. Is taking the NOI right now. It's currently losing the way the current portfolio is being run. It's by the largest operator in the nation. They're losing about $1.8 million a year. They're very heavy on overhead. It's a typical extremely large corporation that some of these assets are very small for them. They specialize in 150 to 250 bed A-class assets. These are 30 to 40, but they put the same cost structure that they would use on the 150 bed asset on a 33 bed asset, and obviously that doesn't pencil. So it's losing about 1.8 on our cost structure. We're going to be about break even in year one, probably lose a couple $100,000. Once we achieve our stabilized occupancy of 85%, we're projecting to increase the NOI to 3.6 million for this asset.
What does that do for the overall value on that NOI?
So right now, that's a great question. Multifamily right now is trading at about a six cap. In 2022, it was trading at a four cap. One of the reasons why we really love this asset class is because these are trading on an 8.5 to 9.5 cap, right? So you're getting a lot more cash on cash for your return. So this fits in great with a multifamily portfolio because if let's just say you're investing in traditional multifamily and your cash on cash returns for the first year might be 3-4%. Your average cash on cash return on a 5-year hold might be 6 or 7%, and then you get a decent exit based on the cap rate. On something like this, on this asset, we're at a 6% cash on cash for year one, and then we're 15% in year two at a 19% cash on cash by year five. So you're giving a lot of cash flow, as you know, Richard, when you're looking at someone's portfolio, trying to help somebody either retire early or to improve their retirement, cash on cash is king. It's not always just about the big exit.
Yeah, so we probably need to touch on a couple of things, and we don't have time to go into super details on if you've not been around us for a little while talking about NOI. NOI simply just means the net operating income that the property is generating. I'll touch on one other thing. There's a column here that's called type, and just so everyone understands what those acronyms are, AL is assisted living, MC is memory care, and there's degrees of memory care in these facilities also, isn't there?
Correct. Yeah. So
Okay.
there's ALA, which is we talked about they need to be able to self-evacuate. ALB, but this is the kind of a little bit of the tricky part about this asset class. It's not all the posted rates. When you go into an asset, you have to really mystery shop it and see all the additional care. So you might go in, they might say, oh, well, our base rate starts at 2,800. Well, what if you need help with meds? Well, it's 4,700 or $470. I have their price sheet in front of me, so that's why I know these. It's $470 for meds to be dispersed for the month. If they need an inhaler, that's another $470, right? If they need help dressing, it could be $200 to $700. If they need help getting to the entrance hall, then so you have it's the additional care revenue, which is a big component of this. Of understanding the underwriting for these asset classes.
I think one thing that we probably need to explain is what is cash on cash return, right? Because everyone looks like, what do I get out of an investment? So it's like there's the cash on cash return, and then there's, when there's an exit, you get your bigger payday. But say a little bit more about cash on cash.
Yeah, basically the cash on cash is when we think of a traditional business, how much money does it spit every year, right? So and then you divide that into your investment. So let's just say if cash was stabilized at you buy an asset for $1,000, it spits $100 a year. Your cash on cash would be 10%, right? Then we look at another one, which is average cash on, or then the average cash on cash. We add up all the years of cash on cash divided by the years of the hold. Right. When we
So
talk
anytime you're doing any kind of real estate transaction, most people don't buy a real estate property all cash. There's usually some kind of mix of debt and then investor capital that's brought in. So it's that cash piece that comes in that you're factoring as what's the return going to be on an annual basis as that thing becomes profitable or becomes more profitable down the road.
Yeah, and the way I always look at this when I help people work on their retirement plan, I always sit there and say, how much money do you need to retire? How much cash do you need now to buy that retirement? Right. So the more cash on cash, if you're going to do that on a 3% return and you need, $100,000 a year, you need to have it's what 30 times that, right? You need $3 million. Now, all of a sudden, if we can have stabilized cash on cash at 10%, you need $100,000 a year. Now, $1 million gets you that same price point, right? So that's where there's other factors, of course, of analyze the investment, but it's how much money do I have to spend to buy my ideal retirement is the way I
Right.
think about it.
Absolutely.
So this here is kind of a little bit more detail that we talk about. This is that asset. We have each individual asset that we're purchasing. What we want to do is make sure we talk about the expense ratio. Lower quartile, -2%, so it'll be 102% expense ratio. Um, we look at occupancy and expense ratio are really a function of each other. So the better the occupancy, lower your fixed cost as a percentage. And when we analyze these, we want the um, expense ratio on a well-performing asset should be between 70 and 80%. So when we did this one here, if we occupancy is at 75%, our expense ratio comes out to 83% of revenue. If we can get it up to 90%, it drops to 79%. This is well within what we consider the safe range. So we're being very conservative when it comes to national averages on our expense ratio. That translates to what we have here is our net operating income. Revenue minus expenses becomes our NOI. Obviously, after this NOI, we have to pay debt, right? This is basically before debt cash flow per asset. At 75% occupancy, we have about $2.8 million to satisfy debt and pay back our investors. At 90% occupancy, we're at about 4.2 million. And you always ask, what does that translate into value? Well, at a 9.5 cap, which we talked about, that's on the more conservative range, 8.5 to 9.5, four major markets. These are obviously in major markets. At 75% occupancy, this is worth $30 million stabilized. At 85% occupancy, it's worth $38 million occupancy. At 90%, it's a $45 million exit. And we're purchasing this for $16 million. And then we're going to put about $3.5 million into this between some reserve capital, fixing the place up, a new facade, new flooring, paint, new lighting. These are all, early 90 or mid 90s assets. And we want to be able to compete with, mid 2010s.
Yeah. I mean, what's important to know is anytime you're looking at something, and this is the part that, a lot of people like the idea of getting involved in real estate investing, and then you get into like these spreadsheets and numbers and this, that, and the other, which is important to understand a baseline of these numbers, but to be able to partner with an operator who has the experience to do it and someone that can underwrite something and look at, hey, this is best case scenario. This is the mid range. And then this is, we're still profitable even if we miss our numbers or something unpredictable happens in the market. We're still protecting that investor principal that they brought to the table to make sure that the deal can operate and still exit profitably.
Yeah, and that's really the key. You really touched on it. This is a team sport, right? No one does this by themselves. We on our team, we'll get in a little bit of that, and I think on the next slide. But we have, this is Rod. He's my partner. He's a kind of a big famous real estate guy. He's the chief investment officer. He's very good on outreach. He's more the aesthetic guy. When we walk an asset, even the senior housing places, he knows what type of lighting we want to use. He wants to know, you can walk into an asset that, the last multifamily property we bought, I think we paid 20 million for it. And we put about 5.5 million into it. And if you put the 5.5 million into the right place, the asset's worth 35 million. I've made that mistake myself. I'm a numbers guy. I'm very good with spreadsheets. I bought an asset in Tampa that we went in there and we spent too much money in the wrong place. We didn't get a return on that investment. So Rod, he's the aesthetic guy. He's really good with, that side of things. I'm good with air conditioners. I'm good with HVAC units, boilers, roofs, structural, and spreadsheets. We work very well together. Tyler, he's our CFO. He's really good with the spreadsheets also. He also has another company where he does a lot of debt sourcing. So he's great dealing with the banks, dealing with the lenders, finding make sure our capital stack is correct for that deal. Matt Rhodes, our technical officer, he's very good on that side of thing, right? Everything AI, IT, our marketing strategy, right? We're trying to get away from, I don't want to bore you guys, but the marketing strategy on senior housing right now is they use these placing agencies like a place for mom or a home for mom. They're very expensive. They're, five, six, $7,000, to place an occupant. And we're doing it now on our other asset we have in Pittsburgh. And we're doing a lot of this with AI, very targeted marketing. It's going to be very effective. And we're driving that cost down. I mean, on this asset here, out of those 14 million in expenses, $1 million a year is in placement charges. So we think we're going to be able to get that down to about 350, $400,000 on this asset. James Whitmer, he's on our investor relations team. He talks to the investors, make sure they're happy. If there's a problem, getting the K1s out on that side. And then we have our operations team, which they have a whole nother roster of everything from patient care, from food services, leasing. These are not mom and pop businesses anymore. People are very effective owning a single asset, 20 to 30 beds. But once you start scaling and get into the, couple hundred bed range, you need to have you need to have a really good solid team.
Absolutely. It's definitely a team sport on every angle of it from A to Z. It's even from the standpoint for us, we look for operators that we can work with, because you never know where a good deal is going to be. So sometimes you go in, you're a limited partner. Sometimes you go in, you're a general partner. It's just, but you can only do so much. There's only so much time in the day, and you got to figure out a way to create leverage with collaboration, with other teams as well and other funds, which is what we kind of talk a lot about here at Investor Next Door Club. So, guys, if you do have any questions, feel free to drop them in. Tomorrow at noon Central Time, we're going to be back with John. We are going to be doing our deeper dive on this type of asset, right? What this asset really can produce over the next 10, 20, 15, 20, 30 years. And so those of you that are club members, you'll have access to that through your dashboard, going to the live Zoom button. Those of you that are not club members that are, like you're curious, you piqued your interest a little bit, you want to know more, talk to the person that invited you to take a look at this masterclass, or you can reach out directly to us. Sandy, if you don't mind, dropping an email in there. Admin at Investor Next Door Club. We're happy to answer your questions and see what we can do to be on the journey with you. What do we have here, John?
Oh, this is just what it means for the investor, right? What we do, our plan is kind of a little bit more we're going to get in for tomorrow, right? How we understand, historical rent growth. It's going to be, this is kind of a lead into what we're going to talk about tomorrow. A little more detail. So,
Well, the one thing about real estate is it involves numbers. I know a lot of times when people think of real estate, they look at you know, the flashy or the sexy, the brand new, and most of that is left for the big firms that have billions of dollars, that very patient capital, they pay out very, very small returns. But when you look at, teams, like, Rod and John are a part of, or Investor Next Door Club, we're looking for the deals sometimes that no one else is really looking for, where you can create that real value add and create an asymmetrical type return, something that you wouldn't just normally find. A lot of the greatest deals come because it was just word of mouth. And when you find an operator such as John's talking about with this portfolio or even other deals that we've all been a part of, we're coming in as a solution, right? They're in trouble. We're coming in as a solution. And when you come in with a solution, you're able to create a value that's not presently there. And that only helps everyone involved win. On top of that, it even the customer, the tenant, right? The person that's occupying, they get a win because now they get a great facility with a great atmosphere and a great community. So I look at this whole trend that's happening as an opportunity for people with good character, good competency, good capital to come in and just make an improvement in a market that is lacking where there's a void.
Well said. I couldn't agree more.
Well, awesome. Well, we don't have any questions. I think we gave them a lot of information, probably a lot to chew on here. What I do want you to know is that when you participate with Investor Next Door Club, you get access to the people that we work with, which is why we built this over the past 20 years of my time of having two real estate funds, being in capital raising, doing our own deals. What I can tell you is that if we could have had a system like this 20 years ago where we could connect with real operators and have a real low entry access point to come in on these types of deals, we would have been much further along a whole lot faster. But, you know, we got technology on our side today. We got laws and regulations on our side today, and there's just a lot that we can do a whole lot faster inside of a community versus than just going at this as a solo. You know, I think John, for years with the car wash stuff, you were a solo operator for a long time, right?
Yeah, I built, I had six car washes, two oil changes, a gas station, and I wore so many different hats, I couldn't scale any more than that. And it wasn't until I started retiring from that business and started getting into real estate, I learned the beauty of the syndication model, right? The deal of pooling resources. And I really call it specialization, right? Because if you want to be great at everything, you have to be really great at one thing. And it allows me to partner with people. Before I was, I was the liaison with legal. I was the liaison with the CPAs. I was a liaison with the marketing. I was a liaison with the contractors. I dealt with the employees. I dealt with staffing. And it was very hard to be great at any one thing. And then when I got in this real estate business and I found myself on this really incredible team where everybody is so good at what they do, scaling becomes very easy I mean, I'm the CEO now, so it's a little bit different, but everybody on my team is so good at what they do. They're all better at their aspect than I am. I kind of have to put the pieces together, but you're really able to see real growth when Matt can just dig into the marketing and he can make us the most efficient marketing machine. And we're going to be more efficient than Brookdale, who's the largest operator in the nation. We can operate more efficiently than they can because we specialize.
Yeah. If you try to row all the paddles yourself at the same time, you're not getting very far in a canoe. So it's great when everyone is in charge of their own paddle and rowing in the same direction and just makes things more efficient and it makes it fun, because winning becomes a whole lot more predictable at that point. So well, guys, I appreciate y'all being on for this masterclass. We will be back on tomorrow for our club members inside of our private community. They'll access that through their dashboard at Investor Next Door Club. Those of you that have questions, feel free to send us questions. If you need to get back to the person that introduced you to this, then get back to them. But John, thank you so much for being on. I was looking forward to at least getting our community exposed to this. It's nothing that we've done, but we're looking forward to being able to work with you on these types of projects.
Well, thank you for having me. I'm looking forward to tomorrow and continue this conversation.
Awesome. Sounds good. Well, everyone, have a great night, and we look forward to being on the journey with you guys.
Thanks, guys.